Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
February 11th, 2026. If you were sitting at your terminal this morning watching the pre-market tape, you didn't just see a decline. You saw a capitulation. Before the opening bell even rang, Unity Software, a company that practically built the mobile gaming industry, it didn't just slip, it collapsed. We're talking about a 27.01% haircut in a matter of hours, dropping the stock to, approximately $21.21.
It was brutal. I was watching the tape and the volume was just screaming, "Get me out." I mean, we're talking about a stock that closed the previous session at 28.05. It had technical support, or, so people thought. The RSI was hovering around 34, suggesting it was oversold, and yet, the floor completely fell out. Support levels shattered. The technicals didn't matter when everyone rushed for the same exit at the same time.
It was a bloodbath, no doubt. But while the market sees a disaster, I'm looking at the exact same chart, the exact same earnings report, and I see something completely different. I see a massive dislocation. The market is panicking over a transition they don't understand, treating a strategic surgery like a fatal wound.
Oh, I think the market understands it perfectly. That's the problem. I don't see a dislocation, I see a reality check. You look at that chart and see a discount, I see a fallen angel that's finally admitting it can't fly. We are looking at a stock now trading near the absolute bottom of its 52-week range. The high was over $52. That feels like a different era now. This drop isn't an overreaction, it's a direct response to guidance that, frankly, flattened the entire growth thesis for 2026.
I see why you think that, and certainly the market hates uncertainty. But let me give you a different perspective. What we are witnessing is a V-shaped recovery in fundamentals that is, right now, being masked by a U-shaped stock chart. The sell-off is a reaction to conservative guidance for Q1 2026, yes. But that guidance is obscuring a successful, massive strategic pivot. They are effectively swapping out a decaying legacy ad business for a high-growth AI platform. The market is punishing them for the surgery, but the patient is actually getting stronger.
The patient is on life support, if you ask me. You can call it a pivot, I call it a broken thesis. The core question we have to answer here is simple. Can Unity actually achieve the growth required to justify even its current valuation, let alone a future one? I mean, we're talking about a company that needs to hit a 17.46% compound annual growth rate to 5x over the next decade. And right now, with the Growth Solutions segment showing a seasonal step down and the existential threat of AI world models looming, I think that ceiling is much lower than you believe.
That is the core question. Is this an existential crisis or a generational buying opportunity? I am firmly in the camp of the latter. Let's look at the new Unity. This isn't the reckless spender of 2021. Under CEO Matthew Bromberg and CFO Jared Yahez, we are seeing true operational rigor. Look at the Q4 2025 financials released this morning. Revenue is up 10.1% year over year to $503.1 million. But more importantly, look at the discipline. Adjusted EBITDA margin hit 25%. That's up 200 basis points. They've narrowed the net loss to $89 million. This is a company that is finally professionalizing.
Professionalizing? Maybe. But shrinking? Definitely. You point to the Q4 beat, and that's fine, but markets trade on the future, not the past. And the future they just guided for suggests stagnation. While the stock is technically up about 30% over the last 52 weeks, look at the year-to-date performance for 2026. It is down nearly 38%. That signals deep structural skepticism. You have a management team promising a turnaround, but the guidance for Q1 2026 suggests that the core growth engine is sputtering. You can't cut your way to a 5x return.
I'm not convinced by that line of reasoning because you're conflating the growth segment's transition with stagnation. Let's dig into that because this is really the heart of the misunderstanding. You're seeing a flat line in total revenue and assuming the business is dead, I'm seeing the intentional decommissioning of the legacy iron source ad network, which is low quality, and the rapid ascent of the vector AI platform.
But you can't just wave away the iron source decline. Decommissioning is a polite way to say it's dying on the vine, isn't it? IronSource was supposed to be the crown jewel of their monetization strategy. They paid billions for it. Now you're telling me that because it's shrinking to less than 6% of revenue by Q1 2026, that's actually good news? That is a staggering collapse. It is dragging down the entire growth segment. When you have a legacy business rotting away that fast, it masks whatever growth you claim is happening elsewhere. It's a red flag for ad tech volatility.
It's not rotting. It's being replaced. That's a crucial distinction. Think of it like calories. IronSource was junk food, high volume, but low nutritional value for the advertisers. It was legacy ad tech based on volume. The future is Vector, and the data backs this up. Vector isn't just another ad network. It's a complete neural network overhaul of their ad stack. It's using AI to predict user value in a way IronSource never could. Vector grew 53% in the 3 quarters post-launch. In fact, in January 2026, just last month, Vector hit its highest revenue month ever. They are targeting a $1 billion annual run rate by the end of this year. This is a shift to quality. They are moving from high-volume, low-value ad tech to a modern, AI-driven stack that actually delivers return on ad spend.
I come at it from a different way. You're banking everything on Vector growing fast enough to fill the hole IronSource is digging. Mid-teen sequential growth is nice, but is it enough? You're talking about a portfolio reset, but to me it looks like they are frantically trying to swap engines on a plane that's losing altitude. You have a massive hole in revenue being created by IronSource cratering. You need Vector to not just grow, but to grow miraculously fast just to get back to zero growth overall. And while they are doing that, they are fighting a war on the other front, the create side, where the competitive moat is, well, it's drying up.
I disagree that the moat is drying up. But let's talk about the competition. You're obviously referring to Epic Games and Unreal Engine.
I am, and the numbers there are concerning for Unity. While Unity still leads in volume, sure, 51% of games on Steam in 2024 were Unity. Unreal has overtaken them in actual units sold. Unreal is at 31% versus Unity's 26%. That means the games that are actually making money, the high-budget AAA titles, are being built on Unreal, and the developer sentiment is shifting. Surveys show 53.9% of developers want to use Unreal more in the coming year, compared to only 46% for Unity. The mind share is bleeding away.
That's an interesting point, though. I would frame it differently. Unreal has always won the high-end graphics war. That's not new. But Unity's moat is in mobile, where they hold a massive 70% market share. That is incredibly sticky. But the real story, the one the market is completely ignoring in this sell-off, is the non-gaming opportunity, the industrial metaverse and digital twins.
Right, but we've been hearing about the industrial metaverse for years. It feels like a buzzword designed to distract from the gaming slowdown.
It's not just a buzzword anymore. We have hard data. The total addressable market for digital twins is estimated to hit anywhere from $240 billion to $800 billion by 2035. Even if Unity only captures 1 or 2% of that, we're talking about billions in revenue. And here is why Unity wins there. C#. Unity's scripting language is C#, which is infinitely more accessible for enterprise developers at places like BMW or construction firms than Unreal C++. If you're an engineer at a car company, you aren't a C++ wizard. You want accessibility. That's why Unity is gaining traction in automotive and manufacturing.
That's a compelling argument, but have you considered the technological displacement that makes both C# and C++ irrelevant? Let's pivot to the real fear. The thing that I think actually caused that 27% drop, it wasn't the earnings guidance. It was the existential dread. We just saw the unveiling of things like Google's Project Genie and OpenAI's Sora.
The text-to-game fear?
Exactly. Why do I need a game engine? Why do I need to script in C# when I can type a prompt and generate an interactive world? The narrative is simple. Why do I need Unity's complex engine when I can just type, "Make me a game where a knight fights a dragon," and the AI generates the video? If AI can generate the pixels and the interaction, Unity's execution layer becomes obsolete. The market is looking at Project Genie and wondering if Unity is the Kodak of the 2020s.
I see the fear that it's fundamentally misplaced. The text-to-game fallacy is seductive, I'll grant you that. But it fundamentally misunderstands how software works.
This is where we have to listen to CEO Matthew Bromberg because he nailed this distinction. It's the difference between probabilistic generation and deterministic logic.
Go on, explain that for the listener who isn't a computer scientist.
Okay, an AI model like Sora or Genie is a dreamer. It is probabilistic. It guesses what the next pixel should be based on training data. It hallucinates a beautiful image. That works for a video, maybe. But a game. A game isn't a dream. A game is a machine. A game requires strict rules, physics, netcode. If I press jump, I need to jump exactly 2.5 meters high every single time. If I shoot a player in a competitive shooter, the game needs to know exactly what happened, the trajectory, the wind, the armor value, and subtract exactly 15 hit points. That is deterministic. You need a deterministic engine to run the logic. You cannot hallucinate a competitive shooter match. It breaks the game.
I agree with you. For 2026, maybe even 2027, but you are betting against the speed of AI improvement. Right now, Genie is low fidelity, 720p maybe, but if we get to 60 frames per second, real-time interactive generation, you're betting that we won't have hybrid models where the AI generates the world and a logic layer constrains it. And if that happens, Unity's value proposition, which is we make the hard stuff easy, disappears because the AI makes the hard stuff instant. The gray box phase is handled by AI, sure, but the lines are blurring.
But Unity is becoming that logic layer. That's the pivot. Unity says they will integrate these models, the Unity AI Gateway, and that's a smart pivot. They become the essential connective tissue between the creative AI and the functional game.
But if they are just the wrapper around the AI model, they don't command an 88x earnings multiple. Wrappers get commoditized. Engines get paid. If the AI becomes the engine, Unity becomes a wrapper, and wrappers don't command premium valuations.
That brings us to the valuation. You mentioned the multiple earlier.
I did. Even after this crash, Unity is trading at a high forward earnings multiple, around 88x as of January 2026. That is priced for perfection, and as we've established with this Q1 guidance, things are far from perfect.
You're looking at the PE on depressed earnings during a turnaround. That's the wrong metric. We need to look at the long-term compounding capability. Let's boil this down. We aren't day trading here. We are asking if Unity can 5x over the next decade. To do that, they need a compound annual growth rate of 17.46%.
Which is nearly double the historical average of the S&P 500.
Correct, but look at their history. Their 5-year revenue CAGR is 19.1%. Even with the recent stumble, the capacity for that growth is in the DNA. If Vector hits that $1 billion run rate and they capture just a sliver of that digital twin market, BMW, construction, digital factories, that 17% growth becomes a lowball estimate. You can buy that optionality today for $21. Analyst price targets right now go as high as $63. If they just hit the analyst high target, that's a 3x return right there. The downside is priced in at 21. The upside is asymmetrical.
I'm sorry, but that assumes the fallen angel can fly again. You're assuming the multiple holds up. If the market decides Unity is a legacy software provider and derates it to a standard industrial multiple, that stock price goes nowhere even if revenue grows. Or worse, it's a value trap. You are asking investors to catch a falling knife because you believe the handle is made of gold. They have $2.23 billion in convertible notes. The debt-to-equity ratio is 64.7%. Sure, net debt is manageable now, but if interest rates stay high and growth stays flat, that debt becomes a noose.
The net debt ratio is 9.7%. They have over $2 billion in cash. This isn't a distressed asset, it's a misunderstood one. They have a cash runway for years. They canceled the runtime fee, which was the biggest overhang on developer trust. They've reset the pricing to a subscription model that makes sense. Unity Pro, Unity Enterprise. They are finally operating like a business, not a startup. Trust is hard to rebuild, though. That runtime fee debacle left a scar, and while they fix the pricing, developers have long memories. That 53.9% of developers looking at Unreal, that's the scar tissue.
And yet, Unity 6 is seeing the fastest adoption rate in the company's history. The product is speaking for itself.
We'll see if adoption translates to monetization.
So, bringing this back to the crash on February 11th, we have a 27% drop. You think it's a warning? I do. I think the panic might be slightly overblown in the immediate term. 27% is a lot, but the structural risks are real. The path to a 5x return requires flawless execution in unproven markets like digital twins, all while fighting a two-front war. They have Unreal squeezing them from the top on fidelity, and AI squeezing them from the bottom on ease of creation. And frankly, the flattening guidance for Q1 tells me they don't have the ammo to fight both effectively right now. That $21 price tag isn't a gift. It's a warning sign that the market believes the best days are behind them.
And I view this as a rare entry point. The falling angel narrative is outdated. It ignores the $2 billion cash pile, the manageable debt, and the fact that, for the first time, management is prioritizing profitability over growth at all costs. The shift from iron source to vector is painful in the short term, like ripping off a Band-Aid, but it raises the ceiling for the next decade. This is essential infrastructure for 3D content, whether that's a mobile game or a digital factory.
Well, for the sake of the investors who held through that pre-market drop, I hope you're right, but I'll be watching one number, the vector adoption rate. If that slows down, the thesis breaks.
Agreed. The key metric isn't the stock price today, it's whether vector can outpace the iron source decay in the next 2 quarters. If they pull that off, today's price of $21 will look like a gift.
Or a trap.
Only time in the earnings reports will tell.
And that is where we leave it.
Exactly.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.